Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. The IMF published its influential World Economic Outlook this week and opened with the words, "Global economic prospects have worsened significantly since our last report, largely because of Russia's invasion of Ukraine." The impact of the crisis is, of course, doubly severe in that it not only reduces global growth, but adds to inflation as fuel and food prices surge. The latter is particularly worrying. Soaring prices for cereals and vegetable oils mean a looming food crisis for much of the emerging world. Indeed, 45 of the weaker economies of the world import more than a third of their food needs from Russia and Ukraine. For investors too, it's a troubling time, with problems in every asset class. Yes, cash is instinctively attractive as interest rates rise, but of course with soaring inflation rates, real yields are very negative indeed. Bond markets have suffered significant losses, and even after yields have backed up, they're still not even half core inflation rates around the world. Finally, equity markets have fallen by more than 7.5% in local currency terms around the world, with particular sharp drops in China and the emerging world and in aggressive growth stocks. So where should investors go to hide? How can they build an asset allocation in such remarkably challenging times? And what does it mean for your portfolio? We'll look at this in the slides ahead. So let's begin with the inflation dashboard on the first slide. In the top left-hand panel, I've shown the G10 Inflation Surprise Index. This is where inflation data comes in ahead of expectations or higher than anticipated across the major economies of the world. At 113, I'm afraid that's still climbing, showing that no real easing of inflation pressures around the world. The US CPI climbing now at 8.5% year on year. In the UK, the number is 7%. But Bloomberg are estimating for the second quarter that we peak somewhere around 9% here in Britain. On the right-hand panel, food and oil prices, that food price index I mentioned earlier, surging to 159, well above the 2011 levels that saw such turmoil and political destabilisation across the emerging world. Finally, Brent crude in the bottom right-hand panel, hovering at around $105 to $110 a barrel. What does all this mean for interest rates around the world? Well, it means a scramble to normalise policy. This is the sort of trajectory we see the dotted blue line as our base case for the Federal Reserve, rising rapidly to 2.5%, a little bit above neutral, and then easing off a little bit as they've hopefully squeezed a little bit of demand out of the system. 2, possibly 3 half-point rate rises needed to get there or to somewhere close to neutral rate by year end. Other central banks following rapidly in their footsteps. We've seen particularly this week a more hawkish series of ECB statements suggesting that they'll begin to move rates aggressively upwards from July onwards. In addition, of course, central banks will be dialing back their QE policies, replacing them with QT, quantitative tightening, as they run down their balance sheets. We expect the Federal Reserve to withdraw about $1 trillion from its balance sheet as maturities fall due over the next 12 months. Put together, this is a challenging backdrop for financial markets, rising inflation and tightening interest rates, and you can see the impact year to date. Yes, gold has risen by 7%, but pretty well other asset is down by at least that amount. World equity is down by 8% in local currency terms, emerging markets down slightly more, and gilts and bond markets falling around the world by almost 10%. The dollar index continuing to climb as people look to the US as a safe haven status. That of course has the effect of tightening policy, putting again additional pressure onto the emerging world. So where do we go for some sort of comfort here? Where do we take our asset allocation policy to take advantage of growth where there is growth? Well, first of all, I show on the left-hand panel 1-year forward earnings for global equities. And you'll see those are still climbing and are substantially above the levels they were at pre-pandemic crisis back at the end of 2019. So underlying corporate earnings are surprisingly robust, and interestingly, they're triggering record levels of share buybacks across the US and global markets. Secondly, the turmoil that we have seen and the rising interest rate backdrop has compressed valuations. They're still not particularly low, US equities trading on 20 times forward and global equities on 17 times forward. But look at Europe there and the UK down at 13 times forward earnings. Valuations definitely more attractive. The second area that interests us across equity markets is the impact of the accelerated move to decarbonise the economy, both because of climate goals and because of the Ukraine agenda. a total of $9.2 trillion according to McKinsey spent annually to achieve a net zero by 2050 goal, $3.5 trillion of that new spend across power, industry, mobility, banking, buildings, agriculture and forestry. An extraordinary spread of demand which we think will underpin corporate earnings going forward. So to wrap this up as we look at the world today, in our bond market still remaining underweight, we just don't see value there and still upside risk as inflation measures climb. In equities, despite all the challenges, strong cash flow, strong dividend numbers and underpinnings of climate change spend around the world means that we still think we can make money in your thematically driven equity portfolios. So that's the core and neutral positioning in portfolios. In alternatives, again a focus on renewables and infrastructure, and particularly on cash flows that are broadly inflation linked. So as inflation rises, you, the investor, are protected, taking the role, if you like, of underlying bonds. A tactical position in cash, this is going to be a very uncertain time and policy is going to be very varied, so there'll be opportunities to add cash tactically. So it's a tactical component of your overall thinking. Well, I hope that gives you some hope that despite the huge geopolitical and economic challenges we have ahead, there are opportunities in financial markets and across our balanced portfolios. Thank you.